First of all, let's talk about the volatility in tech. Tech stocks are historically volatile. They trade at high PEs. Many of them trade based on growth metrics, not necessarily earnings. And that gives them very, very high multiples. And so generally speaking, they have volatility. But the way I look at it in corrections like this is, has anything fundamentally changed in their business models? I mean, are you going to use Zoom less? There's a speculative name. Are you going to use Google less? Or is it going to continue to grow? Is Microsoft still going to be an enterprise platform? The answer is yes to all these questions. And so when you get volatility, generally speaking, in my world, I take advantage of it because I have to deploy capital all the time and I have to decide where am I going to put it. I like growth and I understand it's going to be volatile. And days like this, I remind myself, I've seen this movie before. Go back 17 years on Amazon, which I've owned for almost that entire stretch. We had 30, 40, 50% corrections each year. And yet look where you end up today. And so I look at it and say to myself, let's learn from the past, apply that to the future, take advantage of volatility. The economy is strong. The use case for technology, it gets more important to enterprise every day in every part of the globe. That's the investment thesis.
So Kevin, we know the new year brings a lot of headwinds, but there are also lots of opportunities. So what is the biggest opportunity for investors as you see it in the new year?
Well, the one that I really found interesting over the last 24 months has been crypto and blockchain technologies and tokens and NFTs. You know, you have to make a binary decision about this stuff. And this is very difficult for many institutions. I talk to them every day because I'm in the indexing business, and many of them have not even started their journey into cryptocurrencies. But the reason you should think about it is this. This is how I wrap my head around it, and I think it helps investors to think this way. If you invest in Microsoft and Google and Amazon and so many of these other platforms, what is the core you're investing in? It's basically software. Google software. Well, Bitcoin is not a coin, it's actually software. The blockchain is software. Ethereum is software. HBAR is software. Polygon is software. So the real decision is if you're willing to invest in software because it's a productivity tool as an equity, such as Google, why wouldn't you invest in software such as Ethereum? Because it provides a service, particularly in payment systems, that is being used globally. And that's sort of my investment thesis. And then the question is which coins, which tokens, which blockchains? And for that, I apply the same rules of diversification I apply to my stocks and bonds. No more than 5% in any one position, no more than 20% in the whole sector. So I'm not anywhere near 20% in crypto. I've just gone over 10.7 in our operating company, but I have a plethora of positions. And I'm going to make this decision there that this is even more volatile than technology equities. And it certainly is. Bitcoin's having one of its worst starts ever. But you have to get used to it, just like you had to get used to Amazon, where it would have these 30 to 50% corrections. Same thing with Bitcoin.
So are you using crypto sort of as a way to hedge or diversify from other assets like real estate, for instance? Are you using it sort of instead of the way we would traditionally use gold as a hedge?
That's an excellent question. And the answer is yes. And there's a direct tie into real estate. Here was my dilemma last year. I sold a lot of our commercial real estate in our portfolio, turned into cash, called my cash desk, said, what are we getting for this cash? Because I haven't got any ideas to deploy it yet. I need some time because I like to put cash back in the market slowly, take advantage of corrective days like this, et cetera. And they said, we can give 20 basis points, 20 basis points. And I said, wait a second, inflation's over 6%. That means I'm being taxed at 5.8% on holding cash. And that was when I started my exploration into crypto. And it took me to two platforms that I use today, FTX, for where I hold a lot of my, it's a centralized, and I have to disclose, I'm a paid spokesperson and an investor in FTX and use their platform, and Circle, where I use USDC, where I stake stable coins and get somewhere between 4 and 6% interest. That was my first exposure. And let me tell you something, you know, it took me 6 months to get my own compliance department and my own external auditor to agree to sign my statements. That's how difficult this is going to be. But as and that is in fact the tremendous potential of crypto. If we make it regulated, if we get institutions into it and find a way for them to be compliant, there's trillions of dollars that are going to come into this space because it has a pragmatic use. Now I'm at least keeping pace with inflation on my Circle stake, and I've got a wide range of holdings in my FTX account, and it's completely compliant with my external auditors and my internal compliance department. It took a long time to set up. Other institutions are going through the same birthing pains.
Yeah, we'll see if 2022 brings some clearer regulation in that space, Kevin. But I'm curious if you've bought any of those non-fungible tokens, those NFTs, how much of the portfolio is dedicated to those?
No, I don't have a lot of NFTs yet, but I will tell you, I actually believe that the potential for the NFT market is actually larger than Bitcoin. And I'll tell you why. The idea, and let's take a physical asset. The one I like to use as an example is watches. I'm a huge watch collector. I have a massive collection of watches. One of the biggest challenges I have is inventory management, insurance management, and then of course, authentication. When people offer me vintage watches, I have to go through a very arduous authentication process to know if it's fake or not. There's so many fake watches in the market. NFTs could solve all of those problems. So in the case, a use case for the multi-billion-dollar watch industry, because the actual trading of secondhand watches is 10 times the size of the original watch market each year, because there's billions of dollars worth of very desirable watches that trade all around the world. If I could turn all of my watches into NFTs, and in that way I could let my insurance company know, look, these are the 10 that are out of the vault this week. Bid me on insurance just for these 10. Here's where they're located. Here's why I want them insured. And all the rest I'd self-insure because they're in a bank vault in some city somewhere. Authentication. Every time I sell that watch, the scan of its dial, which is down at the micron level attached to the NFT, would authenticate it. You could rescan it and prove that it was the original watch. So for that kind of thing, same with real estate, same with fine jewelry, same with pens, same with cars, all of this is going to move onto the chain. And so the best way to invest in it, from my point of view, is take positions like I invested in Mutable.com. They own NFT.com. They're building a curation platform for NFTs everywhere. And so that's an equity that I own. I own Wonderfy.com, which has just bought the largest exchange in Canada. They have 375,000 accounts in a jurisdiction that really is progressive in crypto. The Swiss, the Canadians, the UAE government, some of these places are now becoming a little bit more progressive, and you have to invest in those geographies if you want exposure. So there's a lot going on, but it certainly takes a fair a lot of time in my day just tracking all this stuff. I'd say I spend 40% of my investment day tracking cryptocurrencies now.